All right, good afternoon. My name is Ross Doussan, and my report, my 10 company investment analysis, is on two industries. I'm going to analyze mid tier department stores and consumable fuels. We're going to do a time series and a cross sectional analysis on these two industries. We're going to begin with the mid tier department stores. The five companies I chose for this section are Dillard's, Macy's, JCPenney's, Sears, and Dick's. Dillard's, Macy's, and JCPenney's, they serve fine clothing, fragrance, jewelry, along with some home goods. Sears, they advertise more appliances, home goods, and tools. They do sell clothing, fragrance, and jewelry, though not so much. Dick's is a sporting goods retailer specializing in football and baseball. They also carry all kinds of sporting goods equipment and training goods. So we're going to begin here on the long-term solvency and financial leverage. What I did here is I actually used a point system. Whoever I think is the best in each ratio, basically they get 4 points. Whoever's second best, they get 3 points, 2 points, 1 point, and whoever's last, they get 0 points. And we're going to total up everything at the end and see who the best company is. So what we're going to do, we're going to start with the total debt, total asset ratio from the fiscal year of 2010 to 2016. So we're doing 7 years. And in this, I actually pick Dillard's to be the best choice. You see they have a 20% debt to asset ratio. And Dick's comes in second. They have 0 debt to asset ratio. So Macy's and JCPenney, they're a little bit high for me, and Sears is off the charts. So you do see the point system in the upper right corner. Now moving on, next we're going to move on to the total debt, total equity ratio. And Dillard's and Dick's, they have less than half of debt. So you see them down at the bottom. They're 0.50 and 0. And the economy has been doing better since 2012 in the financial crisis or whatever. But 360% debt to equity that JCPenney is carrying over at the top is kind of high for me. And although debt is cheaper than equity, Macy's does come in first. They're running at 2 times debt to equity, and if debt is cheaper, we like to make money with other people's money. And Sears, again, is off the charts this time again. So. And moving on, we're going to go to the times interest earned ratio. And that's earnings before interest and taxes over the interest expense. And obviously, Dick's is the clear winner in this. They top out way above the charts, way over 100 times the times their interest expenses. Dillard's comes in second. They're at 11. Macy's at an 8.5 multiplier. And JCPenney was better than Sears in its only reported year of 2012. So you see them at right at 2012, right above the right above Sears. And Sears stays slightly negative between 0.03 and negative 1.78. So again, they're going to get 0 points for that. Moving on, we're going to move on to profitability, and we're going to use leverage. We're going to analyze the return on assets and the return on equity. So starting with leverage, we'll keep this in mind as we go through the return on assets and the return on equity because leverage maximizes gains and maximizes losses. So we're taking the average assets over the average equity, and Dick's and Dillard's have the least amount of leverage, so you see them at the bottom. Macy's comes in third from the bottom, so we got about a 4.0 leverage ratio. JCPenney going at 6.0, and Sears went out of space. They just blasted off. I think they stopped reporting in 2015, I think. And on the leverage, I did choose Macy's because we like making money with other people's money again. So moving on to the return on assets, it shows that Dick's has the greatest return on assets, even though they have the least amount of leverage. So that's a really good sign. Dillard's and Macy's, they're pretty much tied. JCPenney is lower, though they've come back, and Sears stopped projecting in 2014. So you can see the top right, we're going to go with Dick's, who has 4 points. And with the return on equity, Dick's didn't top over Macy's. Shows that Macy's is actually above Dick's. Their return on equity is 25%, so that's really, really good. Dick's looks like they're about 15, and Dillard's probably talking about 13 or 12% return on equity. Those are all really high, but we're going to give most of the points to Macy's. We're going to go Dick's is in second, and Dillard's will be in third place. You see JCPenney struggling at the bottom, but hey, maybe they might make a comeback. And Sears is off the charts again. So what I did, I looked at everything, their weighted average cost of capital, and I pretty much summed it down to the economic value added spread for each company. This pretty much sums everything up, whether they're making money or losing money for the creditors going on the weighted average cost of capital. And what you see here is Dick's is, they're pretty steady. They're just making money for their creditors and their shareholders. So that's a really good sign. Macy's, you do see them, they were negative and they came out to be they're in the positive. Same with Dillard's. Well, Dillard's is a little bit more volatile, actually, than Macy's. JCPenney, they're struggling again. And Sears, they're struggling as well. So, Dick's has been number one since 2012. Macy's is more consistent than Dillard's, like I said before. And the other 2 points there. So what I did was, after covering all these points, I pretty much calculated the 4, 3, 2, 1 points, who got first place, who got second. And it shows that actually Dick's came out with 22 points. So I'm going to take them as the best company, and I'll point out some points later on in the presentation on why Dick's is my choice for the mid-tier department stores. So just some extra information for the mid-tier department stores. Looking at the price earnings, trailing 12 months and the forward rates. From the chart on the left side, it shows Dick's has a price earnings ratio of 20, which is high. Macy's and Dillard's are both showing around 12. So Dick's has a good ratio, and the forward PE ratio on the right side, it shows JCPenney making a comeback over the next few years. Dick's is staying pretty consistent, dropping 3 points from 2017, and Dillard's and Macy's stay around the same points as they were in the trailing 12-month PE ratio. I'm going to move on to the enterprise value. And Macy's is huge compared to the competitors, so I feel like they have a cult following, which really helps out with their advertisements and their sales. So we'll watch what happens next year in the fiscal year 2017, which ends in January 30th of 2017. I guess it's right after the Christmas holidays they all report. So Dick's, Dillard's, and JCPenney and Sears are all near the bottom. So we're going to move on to Industry 2, which is consumer oil and gas. So let's start with a couple points. Exxon and Chevron are gas stations seen over the United States, supplying gas to millions of Americans. Conoco, located in Texas, they say that they're the largest independent production company. Hess, they're located in New York. It was a Fortune 100 company. It produces, refines, and transports oil and gas. Marathon Oil, which is headquartered in Texas, provides and refines oil and gas. So let's get this started. We're going to do the same thing that we did for the other companies in the mid-tier department stores. So we're going to start with long-term solvency financial leverage. So we want this high but not too high. We're gonna choose Exxon, because 1,000% debt to asset ratio is pretty high to me. So we're gonna start from the bottom. We're gonna choose Exxon first, Chevron second, then Hess, then Marathon, and then Conoco. Moving on here, the total debt to equity ratio for the fiscal year 2009 to 2015. I'm going to continue the trend that, that debt is cheaper than equity. So that's always a good thing, right? But we're going to continue the trend that we're going to start from the bottom and work our way up. This is, I see that 20 times debt to equity is pretty high for me. So we're going to choose Exxon first, and then Chevron, then Hess, then Marathon, and then Conoco, because going 60 times debt to equity is really high, though I know they're oil companies and they do need a lot of money. So moving on to the times interest earned, you see Exxon and Chevron, they're really sky towering over Conoco, Hess. Chevron does beat Exxon by 8 points from my findings. Marathon's got 20 points, Conoco had 20 points, and Hess with 14 points. And for this, I did use the average times interest earned ratio, because if I used a line chart, it would have just been, you wouldn't have seen any of the other companies, much like you do now. Moving on to profitability, again, we're going to start with leverage and then move on. Conoco is the highest, around 2.35. We're going to work our way down. Exxon has a good bit compared to its peers, and the rest converged around 2015. So we're going to have our point spread as Marathon does get 4 points, and Chevron at 3. Yeah, so I did work my way from the bottom to the top. So whoever has the least amount of leverage should do pretty good as far as what goes on with this, economy in this bad year right here. But we want this to be high. So, I'm going to point out that Exxon is the highest in 2015, followed by Chevron, Conoco, Hess, and Marathon, and then Hess. They all had a pretty bad year, but, I'm going to have to award the points to Exxon and Chevron for doing pretty good, given what this year has been. Return on equity, again, Exxon and Chevron, they're really just powering out the competition here. Let's see, Conoco, Hess, and Marathon, they all converged around 2015, and they all did lose a little bit of money for the return on equity. And this, using the weighted average cost of capital again, using the EVA spread again, showing if they're making money for their creditors and shareholders. We're going to see that Exxon lost the least amount of money, with this bad year, and they seem to be doing the best over this whole trend. So we're going to award the points to Exxon, next Chevron, next Conoco, then Marathon, and then Hess, which is down at the bottom. It's not looking too good in 2015. So the point summary. Exxon does top the charts, then Chevron, Marathon, Conoco, and Hess down at the bottom. Some extra information right here shows the price earnings and the forward price earnings. Both Chevron pretty high, so maybe they might make a comeback over Exxon. That's the enterprise value for the company. And the top two companies, Dix and Exxon, basically Dix, they're running on no debt. Exxon, compared to its peers, they're running on a low debt. Dix can pay their creditors. Exxon can also pay its creditors. Dix return on asset is highest. Exxon, the leverage is in the middle class, not too high, not too low. They also have a high return on assets, return on equity for each company. And Dix, they had the climbing EVA spread through the years. Exxon, they did fare the best in the EVA spread through these tough times. And the chosen winner, I like both companies as they're both the best in class and will serve a diversified portfolio well. Given the information provided, I'll have to choose Dix. They do show continued uptrends in the EVA spread. With little to no debt, Dix does give back a good return with little to no risk. So the winner and my chosen company is Dix Sporting Goods for this presentation. Thank you, sir. Thank you, class. I hope y'all have a great day. Enjoy.